Hey everyone, it's Evan here from the Trade Risk on Friday, November 4th with a weekend market recap video. We are first going to analyze the current market environment. We're going to look at some other markets, sector analysis, and then take a quick look at just a few names at the end of this video. Probably be a little bit shorter. Not a whole lot has changed since our last update on Wednesday, so I don't want to go through great length discussing the same exact levels we mentioned just a couple of days ago. So let's jump into the action here. Friday, we closed lower in the S&P 500 SPY ETF, down by 11 basis points. This marked the 9th day down in a row, and during that 9-day period lower that we've seen, it's been almost 2.5% to the downside. So nothing extreme, but still certainly stretched to the downside. We are oversold. We know that, and there's a lot of sort of oscillators and metrics you could use to sort of measure that. If we go to the weekly chart, the big news this week is that we broke below some very critical support, 212.50, right at the beginning of the week, and that certainly, as you know, hindsight has given way to the sell-off that we saw following. So if we go back here, the 212.50, remember, coincides with the all-time highs from 2014, 2015, which we broke out from in July of this year. So if we go to back to the daily chart, let's take a look at where we are in relation to this latest leg higher. If we use Fibonacci here and we use the Brexit lows all the way to the all-time highs from August, you can see we're just over 50%. We're coming, we're in between this 50% retrace and the 61.8. That's the golden ratio for all you fib traders. The levels you could sort of look at, of course, people will look at the 61.8. That comes in at 206.50. You also have this gap that never got filled back here, which was off of the sort of immediate Brexit reversals in late June. That's also a target down there as well. Not saying we have to go to either of those levels, just looking at sort of points at which we've seen either prior pivots at or prior support at 206. You can see there's a lot of support, or there has been some previous sort of inflection points in that 206 area. So that would be another couple of percent to the downside. If you're looking for targets, it's a bit thin because it's been a while since we've been back here, and it gets a little messy because there has been a lot of trading in this kind of wider range throughout the past couple of years. So that's to the downside. Of course, we are oversold. We know a bounce could be imminent, and certainly we understand that the elections out Tuesday, those results are what the market is very cautious of, and it's essentially been a risk-off sort of trade here into the elections. It feels like nobody wants to be long this market. Everyone is either flat or close to it or hedged up. And again, I use everyone with quotes around it, but it seems like that is the consensus, and everybody is afraid of that Brexit type sell-off. And I think not to overthink the situation, but with everyone so neutral or stepping away, hands off this market right now, I think it almost guarantees a wide move, a repositioning, a reallocating after the election, whether good or bad. You're just likely to see some type of big move, as everyone is so neutral here. They're going to have to start to put back on positions and adjust, and that should lead to some interesting price action on Wednesday. I have zero idea which way this market wants to go, but I wouldn't be surprised to see plus or minus 3% that next day, just because it seems like everyone's so neutralized. Now, I'll probably, I don't like making predictions, and that's not a prediction, just my hunch, and again, take it for what it's worth. With that said, I'll probably eat it and we'll be dead flat Wednesday morning, but who knows? That's the landscape right now. It's tricky. There's a big event on deck. We all know about it, and it's just a matter of what your time frame is and strategy is, and whether or not you want to fully step aside. If you're a short-term trader, obviously you're probably going to be flat or close to it. Makes sense. If you're a longer-term trader or investor, longer term daily, weekly, monthly charts, this may not mean a whole lot to you. So that's the way I'm looking at this market right now. Us as traders, as swing traders, we are very much mostly cash right now, just because we can't take such a big risk in there. We do still have some longs on, but not much exposure in this market. Let's take a look at some of the other major averages. IWM actually saw a little bit of a rebound here on Friday, started to get going almost, I think, 1.5% or so at the highs of the day, but most of that was faded. IWM, of course, was the most, this was the hardest hit sort of market index here on the downside still finished lower by 2%. Last week it finished lower by 2.5%. So it's slowly been giving back those year-to-date gains that it made throughout July, August, September. And the Qs also suffering today and looking pretty vulnerable. You can see they're at sort of a prior spot here from September. We can see if it tries to hold on right now. It doesn't look too promising, but that's the only nearby reference point. If you were to throw fibs from the Brexit lows from here to the highs on the Qs, you can see we're going to be about the 35% retracement, something along that line. So a lot more, bullish in terms of relative positioning right now in these between these markets, but still again oversold, selling very consecutively for the past 2 weeks or so, and looking like it could bounce, but again, we have that event that might keep that bounce at bay until we get the results in from the election. So that is overall the positioning and thought process across the major averages. If we look at some other markets now, TLT catching a bit of a bid here, leaving a nice little island of yesterday's candle. You can see we're below 132, but it does look like we have some life here. Perhaps you're seeing a little bit of a fleet of safety in the TLT now, despite what the Fed's going to do. There's only so many places money can go and feel safe right now. TLT might be one of them, so keep an eye on this. Looked interesting, almost took a long in this, but just keeping it in cash instead. You want to get back above 132. Look at the weekly time frame. You can see the 8 and 20 are heading lower. MACD's negative, so got to be a little cautious there, but could be worth at least a short-term fear trade in TLT. Speaking of that, gold continued to see a nice bounce here into the end of the week, closed strongly, up almost 2.5% on the week. Still a bit of a messy chart, but you have a relatively meaningful pivot low to work against now around this 119 level. Don't see the cleanest price action setup, so I can't chase it, can't get into it, but I do respect at least the up movement we've seen this week. And silver, very similar situation, didn't close at the highs of the week, but still up 3.5%. If you go back to the daily time frame, you can see trying to reclaim or retest at least some of this old supply up here from late August, early September. USO continued to be weak. This was just kind of a landslide lower this week, 10%, almost 10% to the downside. And remember, we talked about this $10 level as sort of the the beeline target that this was making, and it did tag it here on Friday. You could see closed dead center there, a very indecisive kind of candle, is finding some support here. It didn't close on the lows, but we want to see if it can try and stabilize here early next week around this $10 level. Maybe get a trade back to the upside. Looks like a clean trading range. I actually have to see if it holds though, or if it just wants to kind of pierce and just kind of keep breaking lower. UNG also a little bit of a reprieve here on Friday, didn't head lower, pierced Thursday's lows, and then saw a little bit of a bounce, still nothing promising, finishing down 10.5%. So both USO and natural gas, UNG, getting crushed this week, and that's quick reversal trades in both of those, particularly UNG, as it was looking so good just a few weeks ago, breaking to the upside above $9, making year-to-date highs, and then quickly unwinding all of that with back-to-back, basically down north of 20% in just 3 weeks. So extreme move to the downside. That's what happens, fast moves, and that's sort of the way we're looking at it. So getting into some other of the sectors here, two that stand out to the upside. These are the same two we talked about on Wednesday's video. IYT, Transportation Average, still holding up. This is very resilient here. You can see it even closed Friday green, and it's just hovering right at year-to-date highs. So there's a ton of resilience here. Again, if you're going to get that upside pop, expect this group of stocks to move first. XLF also second in relative strength. Again, got hit a little bit this week, pulled off of these highs, but still holding up on a relative basis compared to these other sectors, still holding up real well, all things considered. On the downside, XLP, the staples here really kind of unwinding Thursday and Friday, getting hit pretty hard. I'm not sure if there was other specific earnings news in this or not. I haven't looked specifically what stocks accounted for a lot of this move, but looks certainly vulnerable here, particularly losing this $52 level, which has been significant support going back multiple months. And finally, XLY, the discretionary, we did talk about this on Wednesday, continues to slide lower here, and even XLK, particularly this week, as it started to really lose this sort of majority of supply up here above $47. So you want to be a little cautious across those three sectors. Now, looking at individual names, we're just going to talk about three of them real quick. Amazon's the first one. Looks like this one seems to be really tough shape here. Remember, it lost this trend line, had earnings out, had the gap lower. We saw a little attempt of a bounce here on Monday, Tuesday, but Tuesday ended up kind of reversing, and we've been sinking lower. So we have this open kind of breakaway gap to the downside, break of a trend line. This looks vulnerable. It's a high flyer, right? Trades at a high multiple. You get a lot of, if you perceived risk in the market right now, you're going to get an unwind of these quote unquote riskier, more speculative names. So Amazon selling off a little bit for you longer term guys that are looking to get an entry into this. Keep an eye on it, keep it on your watch list, watch it. This might be, lead to, an eventual retest of 700 or some nice round number where it provide a good, risk adjusted opportunity for the long term. Twitter also holding up really well this week. Again, not participating in the sell-off, just moving sideways here. Again, this could be turned into a negative if we start to really break down from this, next in the coming weeks. But for now, you've got really tight overlapping price action here. You get a gap above it. You get the moving averages were sharply lower, but now they're starting to sort of neutralize here. So it'll be interesting to see which way this breaks. You get a lot of energy being built up over the past couple of weeks, so keep it on watch. And then finally, Alibaba will end here. This one closed down just slightly here on Friday, but you can see it's trying to stabilize right here at this prior low from Monday the 12th of September, and it's kind of developing in this little holding pattern. Remember, it had a great run up through July, August, September, and now it's consolidating a bit. So keep an eye on this if you're waiting for an opportunity, waiting for a dip in Alibaba. This might be it once again, so keep an eye on this stock. Might not be ready just yet, but it's worth watching. So we'll leave it there, a little bit shorter this weekend. Hope everybody has a great week, and thank you so much for watching. I will talk to you soon.